Hey guys, what is going on? This is Dave Daily Trades coming back at you today with another video about AMC. So I am super stoked to be bringing this video to you, and I have put in hours of research behind this. As you can see here, this is about a 5-page document worth of notes of all the research that I've been digging through for the past couple of days. So just a quick overview of what I'm going to be covering in this video. Going to be going over failure to delivers, phantom shares, and how this is driving down the price. Some historical evidence of this going on in the past. Aaron Aaron's famous chess game that he's been playing for the past 4 months. And then also going over proxy votes, some of the new regulatory actions that are going on, and what this means for AMC and GME in the long run. Mostly about AMC because that's where most of my research lies on. But of course, this does heavily relate to GME as well. So let's jump into it and let's start off small here. So first thing I want to cover is what exactly is a failure to deliver. So this is Investopedia, guys. This is a great source for any kind of investing information that you're looking for. Really my go-to source, if I'm being honest. So just to go over the key takeaways here, a failure to deliver refers to not being able to meet trading obligations. In the case of buyers, it means not having the cash. In the case of sellers, it means not having the goods or the stocks. These obligations occur at trade settlement. So what does this mean? We'll jump back over here. So, of course, what failure to deliver is, and we're going to talk about the short side because, of course, we know this is going on with the shorts. So, pretty much it is when someone borrows a stock, but actually, for whatever reason, cannot deliver the stock back to whoever they're borrowing it from. So, let's say Joe over here calls up his broker, says, hey, I need to borrow this share. I'm going to return it back to you in a week. That's essentially a short position. It's borrowing the share. But what happens sometimes is they actually cannot deliver that share back to the person who is on the long side of it because there, of course, are lots of reasons that actually happens. One thing I did want to point out to you guys is retail investors do not have the ability to do this. This only happens with hedge funds and market makers because they can actually go out to brokers, to all these different bodies to pretty much borrow shares. So failure to delivers really kind of jumps into my next discussion point, which are essentially phantom shares. So this is, I've heard a lot of different kind of terms being thrown out there: synthetic shares, phantom shares, fake shares. It's all kind of the same similar thing when you think about it and dive into it. So essentially what happens is pending failure to delivers create what are called phantom shares in the marketplace. When you can't deliver that share back and it's just kind of dumped back into the market, it's this fake share, which is called a phantom share. And what this does is you add more shares, and this is just simple supply and demand, guys. You add more shares into the market than there are available. That's going to dilute the stock price. And what that does is it's going to bring the stock price down. And really the reason behind why this happens is because in the past at least, a lot of firms have done this for companies that they think that are going to go out of business. And a perfect example of this is Toys R Us. And this essentially means that the buyer on the other side of the trades may win shares on paper, but the shares don't even exist. So kind of just to sum this up quickly, guys, when you have these phantom shares in the market, it's going to dilute the stock price. And even when a company tries to raise capital in the future, their share price is so diluted that when they raise the capital, it's just not enough to bring that stock up and to have any value to doing so. So really, we all know who we're fighting here. Major hedge funds, and really the big name that everyone's been talking about is Citadel. And of course, we know they are much more different than any other hedge fund out there right now. And this is mostly because they are fulfilling the orders for Robinhood, Webull, Fidelity, and other brokers as well. But these are really the prime brokers that all of the retail investors are using right now. So when I say they're fulfilling the orders, they're seeing all of our orders being placed every single day, guys. So they have a lot of data and a lot of information coming in, so they know exactly what's going on. And I've been seeing on Twitter lately how some people are saying, don't place limit orders at all because, these hedge funds can see exactly what price we're trying to get to, what price we're going to sell at, and it just gives them a leg up against us. So that's essentially all that means, and that's why we actually shouldn't be setting limit orders or anything like that. We tried to take away as much information so that other hedge funds like Citadel can't actually see what we're thinking on the back end. But of course, it is a catch-22 here because everything that we talk about is on YouTube, Twitter, Reddit, and as we all know, these hedge funds are everywhere and they see everything we are doing. So I would take that with a grain of salt. I don't think it's that big of a deal, but, just to note on that. So pretty much what's happening is Citadel is filling the orders for all of these different brokers, and essentially, which is really funny to think about, but we're at war with the same person that is selling us shares. And of course, these are the synthetic, phantom, whatever you want to call them, but they're fake shares because all they are is pending failure to deliver. So what happens is you place a trade, and I personally trade on Webull, so that's what I'm going to talk about here. But we place a trade on Webull, we send it over to the broker firm, which is Webull. They kind of kick that back over to the market maker, who is Citadel, who is then placing our trade. Big thing to kind of think about here is they do not have shares to be selling us in the first place. There's no more shares. And they're pretty much taking our money, giving us this fake share, and using our money to do other various things so they can actually meet their liquidity requirements to actually be on that short side of the table. And really, we've seen a lot of this in the past, guys. Back in, I believe it was late January when GME and AMC first started kind of taking off, they just shut down trading with Robinhood. And that's because, guys, Citadel has a great relationship with Robinhood, with Webull, with Fidelity, because they're placing all of their orders for them. So, of course, they're going to do that. Why is all these hedge funds kind of getting scared right now? It's because they know they already played that game once. They can't play it again. So that's why they're really getting nervous here, guys. And essentially what I kind of said in the last point is how we're, giving hedge funds money for a fake share that doesn't actually exist. And that's terrible. So think about it. We're paying $100 or call it $1,000 for this crappy Toyota Camry. Essentially what's happening is we're giving them the money, but they're not going to give us that Toyota Camry for months. Who knows when we're actually going to get that. So they get that money, and they're going to go invest that money to make more money so they can buy other cars that they can then sell and do the same thing over and over. And it really is a wash and repeat cycle. So, of course, we all know what's going to happen, and eventually a margin call is going to happen. And when this happens, not sure if I've talked about this in the past, but the high frequency trading. And that essentially is going to just absolutely go nuts. So what happens when a margin call happens or a firm gets liquidated is they just go into the market and just start buying all the shares. So for instance, AMC was trading just about around $10. So which a margin call happens tomorrow. Essentially what happens is all of these orders get put into this high frequency trading software, and essentially just goes up the ladder and says, all right, do we have a bidder at $12? Okay, not $12. Move it up to $14. All right, we had a few orders at $14. Now we just go up and up and up. And this happens until all of those phantom shares, all the failure to delivers, and also all the short positions are covered. And this really is a domino effect, because what is going to happen is we know it's not just Citadel on the short side of things. There's other players in this. So once we have one player get margin called, it's going to be a domino effect until the next player gets margin called, the next player, because the price is going to rapidly jump. And what happens when the price rapidly jumps? That other firm now has to have more liquidity to match that margin in their account. And if they can't, then margin call happens again. So once we see one player get margin called, it's really going to happen very rapidly, and we're going to just see this stock price just go crazy. So one interesting thing I want to talk about, and why some people think that, AMC kind of squeezing has been delayed so much. So I have 3 points that I've really narrowed it down to. And all it is just FUD. So they drive the price down so much that we just sell. We've seen that in the past, but of course, we all know it really hasn't worked much at all. B, they release bad press and try to make us sell. And I did want to pull up one article here on Twitter that I thought was super interesting. So, Market Watch. Of course, they've been one of the number one bashers of AMC for a very long time now. And funny thing is, and this comes from Gordon Leonard 19. Guess who owns $96.4 million worth of Market Watch? Who else other than Citadel? So, that's something that you guys should just keep in the back of your head here. So if you guys see bad articles about AMC or GameStop on Market Watch, then you know where it's coming from and who's really paying to get that information out there. And then the last point that I was reading about that came from Lou versus Wall Street, he kind of brought up the point of they could possibly be waiting for another coronavirus wave. And I'm not sure if you guys know what's going on in India right now, but they're having a terrible late kind of phase come out here where hundreds of thousands of people are just getting infected really out of nowhere. So, maybe that is what they're waiting for. And of course, as we know, back in March of 2019, that's when the economy had the first major crash. And it's really because of the coronavirus shutting down economic activity in cities and suburbs, businesses and all that kind of stuff. So, that is a possibility that they could be waiting for that. So my next item that I want to discuss with you folks here is the Dr. T interview. I saw this on Reddit, and this is just about an hour, maybe a little over an hour long, but totally worth checking out. Super interesting. And Dr. Trimbath really goes in great depth about all of kind of the market manipulation, the failure to delivers, and just historical data that's kind of proven itself since like early 2003. And she has a great background with, kind of working in a lot of regulatory bodies such as the DTCC, clearinghouses, and something with Russia kind of building that new electronic system back in the day. So super interesting. Definitely check it out. Myself, I think I watched that just about 3 times, and these are kind of my notes that I took away from this video, and I think it should be super interesting for you guys, just because this is a real big learning kind of opportunity for us all, because this stuff you'll never see in the news, you'll never see it anywhere else. So bringing this to your attention is something I thought would be super helpful. So she really starts off saying that sometimes in the underwriting agreements, they have certain clauses in that where it says you can actually create more shares to meet the trading demands. So, of course, in a perfect world, this doesn't happen, but sometimes, to balance out the supply and demand curve, you do put more shares into the pool than there are available, which, has happened in the past. That's nothing new. But, that is something I did not know and I thought was super interesting. So typically, short sellers find someone they can borrow a share from. This shorter then gets voting rights, dividends, and other pretty much share rights. So this is, again, something I did not know. That really raised a big red flag, but I am going to bring that up a little later down in my notes. So this share can actually be borrowed multiple times, which is not supposed to happen because the buyer often knows they are not getting a borrowed share at settlement. So what is pretty much happening is short seller borrows a share, but then someone on the long side comes across and actually buys that share. Since they don't mark that share as a short position, you have one person on the long side who purchased that share and then one person actually borrowing it from that person. So one person owns it and then the other person sort of owns it, and it's this real gray area that's going on in the market. And this can just be with negligence here when a short seller doesn't market. And back in the day, Dr. T pretty much went and said, you get this piece of paper, you mark it and you say, okay, this is a short. And buyers would never typically buy that because that person is borrowing it, has all the voting rights, gets the dividends and all of that good stuff. So the buyer, which is us, cannot tell a difference when the share is shorted. When they don't turn on the indicator, the market maker will not know that they are selling the holder a shared stock. So essentially what's happening is we're buying a lot of these shared stocks in the market. And this happens in multiple scenarios because either the writer of the agreement could not borrow the share in the first place, which is just straight up negligence, or could say that, the borrower promised the share, or pretty much just make up some BS excuse as to why they could not get it. And of course, I think we're kind of getting more information now that this is happening a lot more than originally thought back in the day. So, one thing that I thought was really cool too is Dr. T pretty much goes back into early 2003 and then into 2005 with some of the meetings that she had with regulatory bodies and CEOs back in the day. So in 2005, Dr. T pretty much showed a report that essentially took all the votes at shareholder meetings of over 285 proxy votes. And proxy votes are just votes from corporate annual meetings, just like Aaron Adams' AMC shareholder event. When you're voting on new topics that are coming up, like the 500 million share authorization. So what she found is over 285 proxy votes were overvotes. So this means that you pretty much sit down for this meeting, everyone who's a shareholder gets a certain amount of votes, and there were more votes coming in than shares available in the public. So, whoa. This crazy stuff, guys. So this has been going on since 2005. So what Dr. T did was she set out an incentive to some CEOs saying, go out and try to buy shares of your company. So one unnamed CEO pretty much went out and tried to buy 10,000 shares of his company. Interesting enough, he was actually unable to do this because the brokerage could not find the share. And it actually took him, this is not a typo, 2 months to buy shares of the company that he is CEO for. And guys, the brokers really don't know what is going on backstage and where the shares are that are coming into the market. So this isn't the brokerage. This isn't their fault. This is really with market makers and hedge funds that are doing this. So one interesting thing that I kind of thought about is the recent kind of chess play that Aaron Adam did. So, of course, I believe it was April 1st when it first came out, and I have the article right here. Yeah, so AMC stock slides after CEO discusses plan to seek approval for potentially issue more stocks. This was April 1st here, guys. So on April 1st, Adam Aaron came out and said, all right, we're going to vote at the next shareholder meeting for a 500 million share authorization. Of course, this is something we vote on, so that's when all these proxy votes come in. And to me, I personally think that this was information that hedge funds wanted to throw out. Of course, because of FUD, and of course, if this does happen, a squeeze is, of course, never going to happen because there's so many more shares in the market. And they can just drive this thing down with the phantom shares and the failure to deliver. And, we're back at where we were in December at $2 a share or whatever. So hedge funds were pretty much shorting all of these stocks because what happens when you short a stock? You get the voting rights of that share. So they started shorting because they wanted as much voting power to actually approve this vote for a 500 million share authorization. Which Adam Aaron is a very smart guy. And in that interview with Trades, one thing that always stuck out to me was don't vote against Adam Aaron. Do not go against this guy. He is so smart. So pretty much what happens is it comes out, people start shorting to get pretty much the shares to be able to vote against this thing and to pass this. And all these proxy votes start coming in, and Adam Aaron looks at the state and is like, this isn't right. There was absolutely, and guys, this hasn't come out yet, but this is my personal belief here, but we are absolutely seeing lots more proxy votes than actual shares available. And that's why I think Adam Aaron was like, all right, we're taking this off the table. This is not happening this year. So I thought that was super interesting. You know, Adam Aaron could be doing this. He could not be. But this is my interpretation of what is actually going on. And I think the data came out, and I'll jump over here to the chart of AMC. So on this day right here, this is the first day we saw just ridiculous volume. And guys, we've gone over this before, but it was at 1.13 billion, which is, you know, there's 450 million shares available to the public, but that's like 3 to 4 to 5. I don't know. Can't do the mental math right now, but that's a lot more shares than are actually available. So this was the first red flag here, which kind of gave AMC and Adam Aaron some belief of, you know, there really could be some shorting going on, some failure to deliver, some phantom shares, whatever it may be. But I think what they did was they want to test and see what's actually going on. So that's why they first put out that information of, we're going to try to add 500 million shares to the market. They get all these proxy votes, and what happens? They're like, whoa, something is off here. Something really fishy is going on. So let's take this off the table now. But that was only just to get some information, and they wanted those votes to roll in. And since it was something that hedge funds would desperately go crazy for and just be like, yes, let's short it, let's get involved into this, it really gave Adam Aaron kind of the information he needed to know what was going on. So really, to go over this and just to go over some history of what's been going on, back in 2006, ETG filed a lawsuit which was actually never disclosed, and it was settled outside of court. So, of course, I can't find any information of this. But there was 11 brokers that were sued because of a similar thing that's actually happened with all of the proxy votes. The reason for this lawsuit was because brokers were not actually borrowing the shares to be delivered, which is, of course, naked short selling. Naked short selling, again, is, guys, you're shorting shares that you physically don't have. So the triumvirate of trouble is one thing that Dr. T touched upon, and it was short covered by borrowed shares will increase the available shares. So you're covering short positions by borrowed shares. That's going to increase the number of available shares in the market, which therefore dilutes the overall price of a certain company. One person owns it, like I said before, and the other person kind of owns it until it's delivered back to the person that it was borrowed from. So, why do you fail to deliver? Like, why do hedge funds do this essentially? And up to recently, there was actually no penalty for a failure to deliver. And now the NSCC and others are starting to put in penalties for all these failure to delivers. But of course, it's not significant enough where hedge funds are just going to outright stop this. And I'll dig into why they actually will failure to deliver and what's kind of the upside potential for this. So in early 2000s, there was a paper came out that talked about a failure to deliver strategy. And essentially what this means, it's a trading strategy that was very popular and made people absolute boatloads of money. So when you have this money coming in, you have extra money on the table to buy other stocks and make other money where it was well worth it. Because there was only a small fine for a failure to deliver, but you have this money coming in for a week, a month, whatever it may be, and you're on the opposite side taking that money, investing it, shorting, doing whatever you may do. So let's say you get a $5 fine, you're actually making $10. So of course the hedge funds are going to continue to do this. Of course. They're making out like a bandit by doing this. So Dr. T was actually in the troubleshooting department at a previous job, and she would get a list of all the issues on a daily basis. And of course, this list was in order of severity and importance. So things that, are the most important, the biggest issues, that's what her and her team were looking at every single day. So what happens when the companies are victims of naked shorting, they have the ability to drive down the price of a stock and essentially dilute the company's value. So this in turn would essentially bring this topic on her list down to the bottom because it was such a low priority issue. And that's how they were able to really hide what was going on since early 2000s and possibly even before that to now. So this is really kind of interesting. And I kind of look back at Toys R Us. Of course, that was big when I was a little kid, when I was 5 and 6 years old. I remember going to Toys R Us with my parents, looking at all the toys. It was crazy, guys. But essentially what happens is the companies that are victim of this naked short selling, they can't raise capital because what happens is the stock price gets diluted because of that naked short selling. And when you raise capital, you're only getting a portion of the stock price because your stock price, instead of being $50, is now $25. So you raise capital, but you're still so heavily shorted that the price starts going down and down and down. And what happens? Old shareholders that have been holding forever are like, this is a lost cause. I'm going to sell out now. And it essentially just crumbles from the top because of this. And a report did come out, which I was unable to find, but this was something in the interview with Dr. T, where there was just about 755 companies that have gone through the same process, similar to Toys R Us, that were pretty much naked short sold to oblivion and have just been wiped off. And when that company gets wiped off, all of the tangible share papers are actually pretty much ripped up, burned, and no one ever sees that again. So that's why no one really is ever unable to find all of these naked short sell orders, because once the company goes bankrupt, they throw it out. No one looks at it ever again. So one thing that was brought up in that interview again that was super interesting was in 2008, shares of banks, the sources of the failure to delivers, saw their own shares. So let's say like Bank of America, their stocks were having failure to delivers. And what happens? The SEC comes in and stop the shorting of securities for just these banks. No one else, just the banks, and stopped it pretty much. So I personally just find it so funny that they're going to step in, save the banks, but all those other failing companies were just shorted to oblivion and just wiped off the face of the earth. So a little bit more evidence as to what's going on here. So more than 1/3 of companies receive more votes than shares of a company. So how does this happen? It's because of naked short selling, guys. So that means at all their annual shareholder meetings, you're going to have 1/3 of every single company that having votes. They're more than the shares that are available to the public, which absolutely blows my mind. 1/3, guys. I could see it. I really thought this was only with AMC, GME, and the other meme stocks, but this is going on everywhere in every single stock, which is absolutely just blows my mind. So 2020 now called open to positions where trade guaranteed to be applied. This essentially is the failure to deliver, was $183 billion figure. Guys, $183 billion. That is absolutely insane. And this was actually up $40 billion from 2019. So you do have to look at this at one side because I don't want to just be all on this subject. So in the past, I believe it was like 2005, it was just about $4 billion. So you look at that number and it's a huge jump. But of course, since 2005 to 2020 and 2021, there's more ETFs, there's mutual funds, there's all these different funds with all these different shares. So you do have to take that $183 billion figure with kind of a grain of salt because it is, more shares going on. So of course there will be more failure to delivers. But essentially, guys, this is still a huge jump. And really the big thing that stuck out to me was this $40 billion jump from 2019 to 2020. And 2021 has not come out yet, but I do look forward to that coming out to the public. So one thing I did want to say too is that regulatory bodies are actually listening to us. So there were a couple of rules that have been coming out that really are touching on the subject of naked short selling and the phantom shares. And let me bring up this article here. And this is happening in Korea here. So pretty much tougher penalties come into force for naked short selling. I forget exactly where it says it. Oh, right here at the front line. Look at that. So, investors engaged in naked short selling will be fined up to 100% of their order amount, the nation's top financial regulatory said on Tuesday. Excuse me. So, that means they're stepping in and taking some crazy restrictions against naked short selling. I do believe something did come out with Canada as well, where they were going to really crack down on this naked short selling. And guys, what that essentially is going to do is it's going to be put a lot of pressure on the SEC, the DTCC, and all of the regulatory bodies to do the same thing, because it's happening in other markets. So of course it has to happen in our market, or the investors of the United States are just going to take their money and go elsewhere. And that's the last thing that we want to actually happen here. So DTC 003 is pretty much saying that instead of doing monthly reconciliation of the papers, they're actually going to start doing this daily. And it's, I believe actually just a couple years ago they were quarterly, and a few years before that it was just annually. This isn't really a huge change. I would kind of take this with a grain of salt. It pretty much just means that essentially it comes down to just a technical correction, where you have to sign this piece of paper saying that you authorize that this information is correct. Of course, we know there's a lot of lying, manipulation, so I personally don't have too much faith with this changing anything, but of course it is a step in the right direction. The 801 ruling, however, this was kind of interesting. They're saying if your fund is not up to date as it needs to be, you're required to update it in 1 hour. So pretty much you have to have a certain amount of liquidity. I forget the exact requirement, but if you're not up to date with that, I forget what it was before, but now it's 1 hour that you have to make the change to meet that requirement. So that is up quite a bit. So that's going to have some significant difference in the market, and just going to see how that's going to affect. So like I said, they're listening to us on Reddit, they're listening to us on Twitter, not on Discord, because I think that's more private servers and they're probably not in there. But especially with Gary coming in as the new SEC chairman, I really think that he is going to make some change, and they're already behind the scenes making changes. I know you guys already know about the closed door meetings that are happening at the beginning of May. Really looks like it's about all of this naked short selling. They have pressure coming from Japan, Korea, from Canada, from the retail investors. So something has to happen. It's just a matter of time. Last kind of regulation that I'm going to touch upon today is CSDR regulation. You can do a quick Google search to dig into this more, and I'm not going to cover this too much. But this was essentially supposed to happen in 2019, got pushed to 2020, then 2021, and now they're pushing it to 2022, but it is coming back on the table. But pretty much if you fail to deliver, you automatically remove your share and are charged the difference. So this is a computer algorithm pretty much that they're going to put in place where once it's a failure to deliver, you are charged, you remove your share from the market, and you're charged the difference. So that is something that is absolutely huge. So definitely look that up. And maybe in a next video, I'm going to cover this in more depth. I really haven't done my due diligence on this quite yet to provide you guys with that information. So really what this comes down to is, guys, we're living in a very similar time to the 2008 financial crisis. So what happened to cause the market crash is too many people caught on as to what was happening and just started asking questions. And essentially, we're in the same place as 2008. A lot of people know what's going on. And back in 2008, social media wasn't as popular, and the internet was not like it is today, guys. We have this information circling around everywhere, to the point where people who I know who don't know anything about investing bring up AMC and GameStop to me, and I'm blown out of my mind about this. So with this kind of said, the SEC, the DTCC, they all know what's going on, guys. You cannot deny that fact. And they are putting rules in place that are really going to crack down on this. And they really have to, because if they don't, this is going to be terrible to the economy. And this really, I know people have come out and said, when this happens, it's going to collapse the economy. I personally haven't dug too deep into that, but I wouldn't be surprised, and that's why I think they are putting these rules in place. So when this does go down, everyone's not pointing fingers at the SEC, which would be really bad to, the investing community here. So, of course, we've seen it with other hedge funds being liquidated and margin called. And really, it's the first domino kind of falling over in this collapsing. So what I mean by that and what I said before is, you have one hedge fund gets margin called or liquidated with AMC or GameStop. That's going to drive the price up so much that the next hedge fund in line is going to get margin called too because they can't meet that liquidity requirements. And it just happens slowly but surely, and everyone pretty much gets screwed. Stock price goes crazy, and we make out like bandits. So, like I said, Gary Wiensletter, whatever his name is the new administration stepping into all of this, guys. He stepped in at a very crucial time. And he needs to make sure that this doesn't go down so badly where everyone's pointing fingers at him. He's the new guy on the block, and if it does, he's going to be in some deep shit. So, of course, they're moving like crazy, guys. All these closed-door meetings that are happening. They are going to do something. It's a matter of time. And really the biggest thing is they're listening to us, guys. They know what's happening, and they're going to do something about this. So, last thing, too. Earnings is May 6th after the bell, and it's actually going to go crazy. So, where are we here? There were a few other things I did want to point about. Yes, these failure to delivers here. This is kind of touching back on an older point that I made. So, you can see this data just going absolutely insane. 2,709,393 failure to delivers from March 31st to April 14th. And of course, this data comes out every 2 weeks. And guys, this is only with AMC, and this is not including any ETFs. And also, I have read some really interesting articles where they're coming out and saying that there is a certain loophole where you can actually hide some of these failure to delivers. So I haven't, again, dug too deep into that, but that's something I really want to research because that just blows my mind. But this is an incredibly high number, guys. And it's really, really going to make all the difference. So, last but not least, just this wedge pattern, something to look for Monday. A lot of FUD coming out this weekend. We've seen the shills, the bots all coming out saying, they're selling all their shares on Monday. It's going to be a disaster. But guys, I've been holding, like many of you, since January. It's not the first time. It's not the last time we're going to see it. So take that all with a grain of salt. It's actually funny at this point that they're spending so much time trying to scare us. I didn't sell when it hit $5. I'm not going to sell if it hits $2 or if it hits $20. It does not matter to me. But we really are getting very narrow in this wedge pattern here. And I would expect the lowest we're going to see here is just about like 950, 970 around there. And we're going to really trade sidewards until this does break out, if we do trade along this technical pattern. But again, AMC and GameStop are very different from any stock that is ever traded on the market right now. All this data, this wedge pattern, price movements, guys, don't worry about it. We know what's about to go down. The data can be easily manipulated like we've seen in the past, and just take it with a grain of salt. So with that said, guys, if you did find any of this information interesting or useful, please share this around the internet. That would be huge to me. And I would love to see if I could get to 100 subscribers from this video. Leave some comments, like this video, and tune in for the next one, guys.